Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
You know, money doesn't rest when the weekends come. Money's working all the time, 24/7 for you. And that's why we at Talking Real Money are slaving over hot microphones to make your financial life a better one. I am Don McDonald, one of your two hardworking hosts here at Talking Real Money, joined by Mr. Thomas Seacock the Jr. for a whirlwind hour of fun-filled financial frolicking.
Boy, you are. I tell you, I'm stepping away. You're just on, man. You're just rolling.
And
well done. Yes. Yes.
You are lovely little listeners, or big listeners, depending on your size, have the opportunity to be a part of our little get-together here with a phone call to a old-fashioned toll-free number. Like we need those anymore. 855-935-TALK. That's 855-935-8255. Every Saturday we get together here on the radio, and we try to make money easier for you to deal with. We're slaving for you. And then it becomes a podcast. So if you miss some, you can just listen to our podcast and hear everything you missed. So it's so easy. 855-935-8255. And a lot of what we cover on the program is investment oriented, because a lot of what you do is investing for your future, or at least you should be if you're not. And the process of doing so can seem daunting and confusing and frustrating, and we try to make it understandable and logical. We try to look at the markets and go, well, what's making them do what they're doing? Like recently, just in the past few days, U.S. stocks dropped in value because people are like going, oh, wait, we are going to have tariffs. Now, back in February to April, they dropped about 15% because of tariff fears and then rebounded. So we're always trying to figure out what's driving markets so we can maybe somehow predict, but apparently that's not easy to do.
No, it's basically impossible to do, especially in the shorter term. But I think the interesting thing from an article that was just in the New York Times, which is really one of the more interesting pieces I've read in a long time.
It's a great piece by
it really is
by a couple of guys from Goldman Sachs, Jared Cohen and Sam Morgan.
Yeah, and what they're talking about, and the subhead, or maybe the headline says, what is really driving your retirement account? That's what people kind of want to know. Why is it going up? Why is it going down? And they found, I think, looking at a lot of studies, talking to a lot of people, 5 patterns they think you can rely on. Now, again, a little bit of facetiousness there about sort of timing markets. We're not saying these things so you run out and start to move money around. We're just saying that so you might have a better understanding of why money is moving. But
and let me just interject. A lot of people say, well, why didn't the market move when X happened?
Yeah,
this kind
fair.
of explains why.
It's number one is events that slow growth or raise inflation, especially those that alter trade and supply chains.
Ooh, that sounds vaguely familiar.
That was like 2020, wasn't there something like that? Like COVID or something?
Well,
or like
now with
like
the
tariffs.
Trade and supply chains. Tariffs? Maybe?
Yeah. That whole thing. So, but again, to trade on that, you'd have to know it in advance, because once the events happen, well, the market is going to respond. That's one. Number two, again, I think this is fairly straightforward. Structural uncertainty and political uncertainty.
Okay.
I assume structural, political, we know, right?
Political.
Who's
what
going
is
to be
structural?
Leadership?
What does that mean? Structural.
I was hoping you would pine in here.
Well,
for that
I
one.
will. I will.
In.
It's when things are happening that weren't expected in the financial markets, in the business community. COVID again was a structural integrity, not a political integrity thing. It was a surprise, And that's the thing, is markets react to things that surprise them, which by definition means they're unpredictable because they're surprises.
Exactly. Number 3, these are 5 patterns that really drive your retirement accounts, according to a recent article in the New York Times. It says that markets are not good at predicting geopolitical consequences. In other words, what's going to happen as a result of fill in the blank, whatever thing happens, markets. There's always a short-term emotional response to thing, but in the longer haul, what does it all mean?
Well, I remember really clearly back before the 2 Gulf Wars. And in both cases, leading up to those, there was a lot of fear that it would drive the markets down. And then when those events happened, the markets soared. They absolutely soared. So what does drive the markets? What is it? We're going to talk more about that. 855-935-TALK is our phone number. And we're also going to tell you what you can do about it.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
What drives the investment markets? We've talked about a couple of things. It's not what you would expect. It's surprises. It really is surprises. And we're talking about an article written recently in the New York Times by Jared Cohen and Sam Morgan from Goldman Sachs. By the way, Jared Cohen, Oxford Rhodes Scholar, and a presidential historian.
Well, I'm listening.
Right up your alley. So
yeah, exactly.
We've talked about what drives them, but what can you do?
Yeah, okay, but let's go back to the 5 patterns. These are patterns that they found about what drives, stock values. Number 1 was the events that slow growth or raise inflation. Number 2, structural uncertainty and political uncertainty. Well, we've all seen that. Markets are, number 3, not a good predictor, or not good at predicting geopolitical consequence. In other words, if the market goes down, doesn't mean something's going to happen as a result of that. Number 4, this is the one that I think you can do something about. This is the one where you can actually take some action.
Number 4, is it a thing? I mean,
yeah, I think it is.
Is it a thing that drives markets, though? Or
that's true. It doesn't.
It's more of a what do you do about those markets?
How do you deal with markets?
How do you deal with them? Yeah, that's it.
Because number 4 is not all assets move in unison.
Wait.
Boy, we have been saying that for a while now.
Really? Diversification actually has some basis in science?
And you can see that this year, the S&P 500 is up 6.3%, and international small cap value stocks, which most of you don't own, up 26.1%. I mean, there's a divergence for you. It doesn't happen all the time.
Don't you wish you had owned them?
Yeah, exactly.
Like back when we, and by the way, this doesn't show that we can predict anything, okay? But we've been telling you to own those assets for more than a decade.
It's closer to
2 decades.
I think I owned them in 1997,
decades,
so that's getting a long time. Yeah,
we've been telling you to own them for a long time. Don't you wish you'd listened?
Now's your chance. You can listen.
No, but that's the thing. It's that you get in too late.
Well, and people now are saying, well, I should move from here to there just in time for there to do something different than here. Number 5. This is kind of fascinating, actually. What drives markets? Repeated shocks over and over and over markets form immunity. In other words, they kind of say, yeah, all right, we already heard this, been there, done that. We're not going to over-respond, which I find unusual because most time markets are very emotional, especially in the shorter term.
Yeah, but it's
Big reactions
the boy who cried wolf syndrome, I think.
One too many times,
You hear the terrible possibilities. And I think that is part of what happened in 2025 with the tariffs. We heard about all the horrible things that were going to happen with the tariffs, and then they didn't happen right away. Now,
and we really don't know
what
that's going to mean.
But no bad stuff happened right away. We didn't see prices double or triple right away, and so the market said, "Well, look at that. You just told me this was going to be bad, and it wasn't. So I'm going to get back in."
Yeah, and am I going to? Did I read I'm going to get a check or something from all the money that they're collecting for the tariffs, or there's some bonus?
I don't know. Are we getting
a
check now?
I'm always hoping for a check. I'm not kidding. So you said at the end of last segment what you can do about these 5 things. I think the only one you can do anything, frankly, other than have your portfolio designed for good up stock markets and bad down stock markets. I don't know how you're going to respond. I mean, and being diversified, that's about it.
Right.
Really?
And I think the point is that diversification is what bails you out. Because here's the problem. You want to know what's going to happen because you want to hit a home run every time you put money in the market.
Good point.
We're saying hit a couple of singles, strike out once or twice. But if you're batting over 500, which is what you should be able to do with a diversified portfolio based on the past, you should be batting about 750.
That's about right, yeah.
You really should with a diversified
that's what the
portfolio.
Up and down. Yeah, right.
That
up and down
should
markets
make you happy. Quit looking to win all the time and quit getting emotional.
I think the other part that makes people unhappy is they want to look over and see what he or she's doing. It's making more than I'm doing. Why am I not making all that money? I should be making as much money as they are.
Right.
Quit worrying about that, too. That gets people in a lot of trouble.
Then go start the next Amazon. Good for you. Go get it.
God's sakes. Good luck with that. Owning a small business, kind of large business at this point, but I get your point. Yeah. So, but all of these things, again, events that slow growth or raise inflation, hard to see coming. That's why you're already positioned for that. Structural uncertainty. Well, again, you've built the right stock to bond ratio. It's a surprise. You can't really be ready for it. And then I still love diversifying because keeping your expenses low and being tax efficient, those are about the 3 things you can do when it comes to investing in a big picture. The rest of it, good luck.
Welcome to Boring Investing Radio. That's basically, we are the most boring investment advice providers on the radio or on a podcast because we tell you what you don't want to hear, and that is you can't do anything. You just have to settle for good enough. We don't like doing that. But the facts keep pointing toward that strategy. There's nothing else you
I'd
can
say
do.
this backs that up.
It really
pretty
backs
much.
it up.
It does. Yeah.
855-935-TALK is a phone number you can use to spend a little time talking with us about the right way to manage your money. We don't always get it right, but we strive for the right way. And the right way is usually not nearly as much fun or as exciting as you want it to be, but it's probably better for you. 855-935-8255. Let's go to my home state, way up in the Rocky Mountains, Colorado. Lisa, welcome to the program.
Rocky Mountain High.
Thank you very much. Yeah. Thank you very much, and thank you for all your service to the public with honest investing advice.
Boring, though, right? Boring.
Thank you for that kind words. We appreciate it.
Boring is good.
Yes.
Boring is good sometimes. So I had one comment and 2 questions if you have time.
Sure. Absolutely.
Okay. Should I start with the comment?
Yeah.
Depends on how bad the comment is. You might not get to the questions. If it's bad, we might zip. That's over.
The comment's not bad.
Okay.
So I'm a long-time listener, and you had one of your podcasts where you were talking about where people get their investing advice. And throughout my investing career, I guess I got my best advice from books. And you kind of had the opposite advice, or I guess maybe it wasn't advice, but
well, the problem we have with books is that finding the few good ones is really tough in a sea of bad ones, But
and
yeah,
we
we
find
like books.
fewer and fewer people reading. I mean, sure. I mean, I'd say anything that John Bogle's written. There's some stuff Larry Swedger's written. I like Paul Merriman's books, so we're not opposed to them. It's surprising to me, frankly, the number of people who ask us for books, because we have a lot. And Don's written a pretty good book about all this that I think is a great primer about sort of the do's and don'ts of investing, which, by the way, we'll be glad to send you if you haven't read it. So
we will.
Some of my favorite books were A Random Walk Down to Wall Street
Sure.
and all about asset allocation and unconventional success. Those are really, and then I read all of John Bogle's books.
Yeah, wonderful books.
Anyway, that was just.
So no, we're not opposed to reading, and we're not burning books, and we're not opposed to reading. We think that we think it's good. We just find fewer people ask us about that. I think, Don, right? Wouldn't you agree? I don't.
Yeah, I think so. And guess what we're going to have to do, because we have to take a quick break. We're going to take a quick break, and then we're going to come back for your next comment and your questions. Is that right?
These are the questions.
One more.
She did the comment.
Oh, there was just one comment?
Yeah, two
questions. I lost track of whether it was two
questions.
Comments.
It's all good. 2-1. You're good. Yeah.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Well, we're talking to Lisa from Colorado, and we could be talking with you, too, if you call us. You have to call us because we don't know your number. 855-935-TALK, 855-935-8255 every Saturday from noon to 2 Pacific time on Northwest News Radio, and then it becomes a podcast. So let's go back to Lisa. We've had the comment. Now, the next segment of the show is all about questions.
Yeah, what do you got?
Well, I have another comment.
I thought it was two comments.
Driving through
you
Seattle.
were right, and I was wrong again, as usual. I'm sorry.
All right. What's your other comment?
Next comment.
No, it wasn't a scheduled comment. I'm sure glad that I'm not driving through Seattle. After that, you have a traffic report for
you
your
can
brain.
just say that any day at any hour, by the way. It doesn't Saturday afternoon.
Tom lives there, and he says it all the time. Even when he's home by the lake, he goes, I hate driving in Seattle.
I know.
I hate the 405.
I used to live in Portland, Oregon, and
sorry for that, but okay.
When when my husband and I would go away on trips and come back, it would sure be disappointing. And when I come back to my home state now in Colorado, I am so joyful. It's really
Good
nice.
for you.
Anyway.
Yeah.
Oh, now you're making me want to come back to Colorado.
All right,
go ahead.
Lisa, the pressure is now on you. Actually, have to come up with a question. Like, the comments have been great, but actually, the question at this point.
So the first question, I'm on the board for a senior center in my local town, and I'm the youngest on the board. I've been on the board for almost 6 months, and I learned where they were keeping their cash, which was in a checking account, and I suggested two options. I suggested either a high yield savings account or a Vanguard organizational account. And they chose to go with Vanguard because they didn't want to go with some unknown high yield savings account.
That's
and
reasonable.
I wanted to know if you thought there was any difference between just having it in a money market in VMFXX in a Vanguard organizational account versus a high yield savings account. And the rates are pretty similar.
Yeah, the rates are
not
very
a whole
similar.
lot. They're both insured. Well, no, unless is it Vanguard Federal? Is that what I'm hearing?
Yeah, that's
money market?
the federal.
So then, I think that's fine. Yeah.
No,
Yeah,
I think I don't just think
equally
it's
liquid.
fine. I think it's just one is as good as the other because they're going to reflect similar rates because it's a short money rate. Whatever the short money rates are going to be, both of these are going to be at the high end of that short money rate.
The only caveat here is going to be the Vanguard fund is going to have some sort of charge for it. There's a cost to the managing.
Yeah, what was the symbol again for that VM? What was the
V as in victory?
It's VMFXX, and it's a real small amount. I think it's 15 basis points, I think, if I remember.
Yeah, I mean,
right.
again, so, that's, it wouldn't stop me from doing it there. If they decided on Vanguard, I just hold the money in that fund. You can get to it right away, and you're going to, make, as Don said, the high end of short-term money. So I think that's reasonable.
Yeah. Okay. All right. My second question was, So I've been retired for a couple of years now, and I have no financial advisor. I'm doing it myself. And let me give you a little bit of background. I have a third of my money and my husband's money in Roth, and 2/3 in a tax deferred account. And we're all through Vanguard. And I'm pretty well diversified. I have about 30% in international and the rest in U.S. And I have 20% in bonds and treasury bonds, both short and intermediate. And I have 10% in cash reserves in a money market.
So is your question about the asset allocation? Because we're just about out of time here again. So,
okay. Well, my question was, do I need a financial advisor? I mean, I feel like I'm doing fine doing it myself.
Well, two things. One, how much money is in there, roughly, ballpark?
About $2 million.
Okay, so it's a substantial chunk. Are there going to be any issues down the road have you done any kind of income planning? Because you want to make sure that you're going to be comfortable, that what you have is going to be comfortable in the future.
Tom and Don are talking real money.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.
Reality radio for a really great future. We're talking real money.
welcome back to Talking Real Money. Tom Cock here, Don McDonald over there. We'll get back to the calls in just a minute. I want to wrap up the call with Lisa, though, because it's very hard for us to just say yes or no when it comes to do you need a financial advisor.
Oh, you're talking about
really
her
hard.
Financial advisor
question. Because here's the thing. If I had $2 million and I was retired, I'd at least have somebody else look at it, whether or not you hired them to do anything or not, because I can almost guarantee you that a professional is going to say, did you forget this? Did you remember this? It should. Now, if you go to the wrong person, could you get sold something?
Oh.
Yeah.
But I mean,
we just met with somebody.
10.
Yeah, we just met with a couple of people today, and great job on the asset allocation, but other things to consider in the whole financial realm of being retired and all that kind of stuff. So I probably would say, yeah, but I'd find a fee only 100% fiduciary advisor, and I'd tell them up front, look, I just want to know, I'm just checking in here. I don't really want to buy anything. So, and people, the right people get that. People come to us regularly and sit down and have a chat about things. Sometimes they end up hiring. Sometimes they just go off and do it on their own. But I would at least, with a portfolio of that size and in retirement, yeah, I'd get another piece of advice.
I also looked at the high yield savings money market comparison. The Vanguard Federal Money Market Fund has a 7-day SEC yield of 4.23. The Bread Savings High Yield Savings Account, which is Comenity, 4.25.
So really hard to differentiate between those two. And again, they're both insured by the federal government. So they're both okay.
Yeah,
so
the
basically.
So 855-935-8255 is our phone number every Saturday. We love for you to call us and talk with us about your money. And let's do just that in West Palm Beach, Florida. James, you're up. Welcome to the show.
Hey, guys. How you doing? Nice to talk to you again.
Glad you called. What can we do for you today?
I am, this month I'm turning 60, and just a comment before I ask my question. Little by little over the past few years, listening to you guys, I've gradually moved in the direction that you guys have talked about in terms of diversification. So now my current portfolio is at $1.3 million. 60% of it is the Paul Merriman buy and hold, ultimate buy and hold portfolio. 40% of it is bonds. A quarter of the bonds are in ultra short U.S. Treasuries. So my question is, do I still need a separate emergency fund, given that 25% of my money is sitting in Roth or similar kinds of accounts. And if I do need an emergency fund, is there any reason I can't just keep it in a Roth account? Because I'm still contributing. I could still get the money into a Roth account under the current tax rules.
Yeah, remember the Roth, the money has to stay in the Roth for 5 years for that to settle correctly. So you could take it from the older money. I'm not a fan of using Roth for emergency funds.
Yeah, see, I would like to have as much money in my Roth as I can possibly have in my Roth and never draw it down until the last minute, which is, I think, just another it's another good argument for at least having some short-term high-yield savings money.
I would say that would be the starting point to say, okay, really, how much do I need in an emergency short-term savings account? I'd set that aside. Then I'd go back to building the Roth. This is conflation here that makes me nervous.
Yeah, I think it's nice to have it. That Roth money should be sacrosanct until you need it in retirement because it's growing tax-free. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
The hour started out alliteratively, and it continues to be the alliterative hour. Get this, Tom. We just talked to John, right?
James.
I'm sorry. James.
Yep.
Now we have Jimmy, which we're going to go to in just a sec. Then then John, then Jason.
That's a little scary. And if it's the Jason I'm thinking it is, don't put him through.
Oh, really? Well, no, hopefully it's not the one you're thinking. Let's start out with our first of mini, our second
Jimmy.
of mini J's. No, John.
Oh, pardon me.
Yeah,
Sorry.
no, Jimmy in Georgia. Yeah. You're right.
Jimmy in Georgia.
I lost track. Hey, Jimmy, welcome to the program.
How you doing?
Hey, hello.
Yeah, Jimmy,
You're
we're
on,
here.
Sir.
Let's go.
Yep,
Let's talk.
Hey, how's it going? Man, I love you guys' show. Thank you so much for putting me on. I had a question, a quick one. So, I was listening to a financial radio show or a podcast, years ago, and they said something weird on there that stuck with me ever since. They were talking about selling assets to raise cash, and, almost like an aside, the person said, well, obviously, you want to sell assets that have gained in value. But I'm thinking, why wouldn't I want to, let's say I have a balanced portfolio, diversified, and I'm just trying to raise cash out of it. Why wouldn't, and I've been constantly investing in it, why wouldn't I look at every tax lot available to me and either sell the stuff at the smallest gain for the least amount of capital gains taxes, if that mattered to me, or even possibly sell things at a loss as long as it didn't mess up the portfolio balance.
Yeah, it depends. If your goal is to make the most tax-efficient sale in a taxable account, then yes, you're spot on. If your goal is to create cash from a retirement type account where income's going to be income, it doesn't matter, you need to rebalance the account, then you're going to take it most of the time from the winners. So, but I see what you're saying. Yeah, so it's best to go through the lots and say, yeah, I could sell some of this, I could sell some of that.
It works
sure,
really well if you have a portfolio where you've had losses, but these days, not a lot of people have portfolio losses. They're kind of hard to come by.
Oh yeah, I don't have any losses in my account.
Yeah, me neither.
For years. I mean, there was a little bit in April, and then I messed up something in my Roth, or like I bought the same thing in my Roth, so I was going to do like a backwards wash sale risk, so I couldn't sell it in my taxable account. You know, it's like I'm never doing that again, having the same thing in my Roth as my taxable account. But like and now it's recovered, and I can't even get the loss anyways if I wanted.
Let me ask you this question: for what purpose are you raising cash? That really impacts the equation.
That's what I'm imagining. So it's like I'm thinking about slowing down with work, you know, and possibly just having like my qualified dividends and my ordinary income dividends and stuff. So it's like even if I'm constantly investing in my portfolio, you know, on the one hand, I would think, okay, you hold the dividends to the side and spend them as cash throughout the year. Or like if I'm trying to subscribe to the idea that I need to be constantly invested, why wouldn't I just take a look? Like, let's say I reinvest the dividends and they immediately go to a loss. As long as the portfolio, like I'm not over withdrawing, like, you know, a certain percentage and risk in the portfolio, why wouldn't I just stay constantly invested and sell things at either a gain or a loss, whatever's the most advantageous tax law available?
Okay, here I think we're getting into way overthinking territory. If you are going into a situation where you're going to be taking money out to live on, then what you want to do,
which is possible.
Pardon me?
He said that's possible.
Yeah.
Yes.
Which is possible. That's possible.
Then, you're always going to be looking for tax loss selling opportunities. That's aside. We'll set that aside. Let's set that aside. When you are starting to generate income from your portfolio, we believe the best way to do it is to start. You set up a hierarchy of the accounts. You don't touch the 401ks, the IRAs, or the Roth IRAs until later. You start by taking money out of the taxable account. That's where you begin, because you want those others to defer or grow tax-free for a longer period of time. You start with the dividends, because rather than investing them, you're going to be taking money out of that taxable account anyway. The dividends are getting paid out. Take those dividends towards your cash position. Then you sell things that make sense for your rebalancing purposes. So if you have a portion of that portfolio that's gone from what you meant to be 60 now to 70%, those are the assets you're going to start taking out to give yourself some income. You're not going to be adding them into the shorter position. You're just going to be bringing your balance back to the whole portfolio.
This is exhausting. I get the rest of the afternoon off. I don't know. No, okay, but to go back even further, Jimmy, and we do need to move on because we got other people waiting. The plan, if you have a plan in place instead of this kind of, well, maybe, it's going to help you make that determination, figure out the roadmap, and then you
will
start
have figured it out
money
in advance. You will already have the plan as to where the money comes from. So, Jimmy, thanks so much for the call. We appreciate it. J number 2, John in Tumwater. Welcome to the program.
Hello, gentlemen. It's nice to talk to you.
Good to talk with you. What's up?
My question is, I'm trying to help a friend with their deferred compensation from Washington State, and I was, obviously the easy solution is the target date fund, and I was just kind of poking at looking at that fund, and I look at it, and I don't know if I heard you guys talk about it before, but it's got like 25% private equity as part of the equity portfolio, and it also has a sliver of high yield bonds, which I believe are junk bonds.
Yep, they are.
Yeah, okay, but what are the other options? Because the deferred has pretty good fund options. Do you have the list there in front of you?
For the target date funds, it's all of theirs.
No. For the other, I thought they had other, like you could build your own portfolio with the plan there.
Yes. I'm sorry. Yes. So some of the other ones, right, they have like a savings pool fund, a Washington State bond fund.
Yep.
What
else?
Large cap equity, small cap and emerging, right?
Yeah. Well, and international.
And international.
Yeah. We're not now you could have a little bit of high yield bonds. I wouldn't want to have very much. But part 2 is I didn't realize that they had that much. So that comes, by the way, from the Washington State Retirement Investment Board, which invests for the pension program in the great state of Washington, and they do use private equity there. I used to interview the guy that ran that many, many years ago. We used to talk a lot about that. I'm not a fan, and I'm not a fan of it in retirement plan. So probably then, therefore, I would build my own portfolio using the large cap equity index, small cap equity index, international, maybe a third on those, and then whatever the bond part of that's going to be, and do it that way instead of the target date.
Yours is the first call we've had about the retirement strategy.
And we had one a long time ago.
Really?
Yeah,
I don't remember
this part of it. But yeah,
looking at it, I'm going 25% private equity.
That's a little high.
18% real estate. That's just
seems high too.
That's a crazy dangerous fund in my opinion. So I would go with the other fund options and
I would just do a third with the large, the small, and the international, and then divide that by whatever amount of bonds you're going to have and build it that way.
Yep.
Okay.
We can.
All right. Thank you, gentlemen. That was thanks. That was my thought, but I don't like to give free advice to people without at least double checking with somebody.
Yeah.
That knows more than
we
me.
do it all the time. We don't check with anybody, so you should go right ahead. That's not a problem.
That disappoints me in the program.
Me too. We're gonna have to look. We're gonna have to look into that a little bit more and find out because
you were absolutely right. It's the retirement board.
The retirement investment board. Yeah. And I did remember them having, but I didn't remember using it in the in that plan.
Again, this comes back to this whole issue of these people who are in these positions of financial authority thinking they're smarter than everybody else.
Yep, exactly.
And that it's I can confidently state that it's based in ego and more ego than actual fact.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I look further, 8% in tangible assets. That means commodities.
Yeah, right. Yeah, like hogs and that kind of stuff.
So about half the portfolio is in their portfolio. Is in things that are really not great, in our opinion.
We're gonna have to look. I gotta go back and take a deeper dive into all that.
25% private equity, 18% real estate, 8% tangible. That's huge. That's pretty good.
That's more bacon than I would eat, but I'll give it a try. Why not?
Let's go to Sammamish. Jason, welcome to the program. Jason? Hello. Hey, what's up?
There you go. You're on. Go.
Good afternoon, gentlemen. Quick question for you. Well, not a question. So we know the Bureau of Labor Statistics, which has been in the news this week, is something that has been accused of being political in the past. But I did want to get your take on, now that we've had an actual bureaucrat fired for having the quote unquote wrong jobs numbers. What are your thoughts about this? If we do go into an actual recession, and when we're trying to come out of this, how are we going to trust that the numbers are not Trump yes men numbers for the Bureau of Labor Statistics? It's I don't think we've ever seen that particular agency politicized quite like this, and I wanted to get your thoughts on how that could potentially affect the market.
Honestly, I want to go back to work on Monday, so I'm going to be careful
exactly.
here.
And this is what bothers me, is that I'm actually sitting here thinking about my answer carefully before I say it, which shouldn't be the case.
No, because Don and I, unequivocally, we oppose that sort of situation. That you just can't do it.
Right.
Really, you can't. It just because it ends up being like China, or where the numbers are kind of kind of. There's some basis in fact, but in reality, nah.
I mean, there's always a little politicking going on, but this is a statistician with a reputation for giving good numbers. And that talk about politicizing it. Well, the administration has taken politicizing to a whole new level.
Well, and what's crazy is the fact that they've reported what about the higher numbers that they reported the last 2 months that they had to revise down? Were they being political in his favor then? Like, it's just a nonsense argument. It really worries me about the future of that agency and how we're going to rely on jobs numbers, because they're so critical for how the market moves. It's like, how are we going to rely on them in the future?
Well, and decisions about interest rates, which are, now again, we're going to look in September, the odds have gone up to 70%. The traders saying 70% likelihood we're going to see a cut there because of these changes. So, yeah, I don't like it. I don't like that level of interference. And I'm with you. It makes me kind of nervous about what all this means for the future. So
thank you for saying it instead of me.
Right.
Yeah, me too.
Both of you.
Let the haters begin, because the calls will come and we'll get the emails and
derangement syndrome.
I know.
I can't even say the things I want to say anymore.
By the way, and thank you for listening,
America.
Josh.
What
it was
happened?
Not the same Josh, by the way.
No, but why do I have to feel bad about saying what I think politically? Why do I have to feel bad? I never have in the past, not once in the history of me, have I ever felt
You've never had any restraint
like I had
about
to be
anything in the
careful
past.
about what I said politically, ever.
No, or about anything. You've never restrained about anything.
I never
Let it
have.
go all the
And
time.
now it's like, I hate this feeling. Anyway, if you have questions for us, go to talkingrealmoney.com and send them in, or call us at 855-935-TALK on Saturdays. And if you want to meet with an advisor for free for nothing, just go to talkingrealmoney.com and then click on that button that says Meet an Advisor.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.